Hello everyone, my name is Lamarr Baxter. I am the Director of Business Development for Accuplan Benefit Services. I'd like to thank everyone for logging on to today's webinar. Today's topic, we're going to be covering trust deed investing with your self-directed IRA. This is a pretty popular topic as it relates to real estate because not everyone wants to aggressively or should I say actively participate in real estate investing and more or less want to take a passive approach. And because of the popular demand on this subject, I thought it would be a great idea to go ahead and have Mr. Bruce Silverman with HomePath Financial go ahead and give you guys some information on the benefits of using self-directed funds to invest in trust deeds. I'll go ahead and have Mr. Silverman kind of give you a background on himself, and we'll go ahead and get right into the presentation. Just kind of give you an idea what the format's going to look like today. I'm just going to go ahead and I'll give the introduction, go ahead and let Bruce get started, give the information on the trust deed investments, and to kind of give you the ins and outs and how that process works and what the benefits are in terms of making that choice in terms of a passive method of real estate investing. Just to let everyone know on the call that the actual event, the webinar will be muted. No one can actually verbally respond. All chat responses should be done via the chat feature. This event will be recorded, so within 24 to 48 hours, everyone who actually registered for the webinar would actually receive a recording to be able to play it back and listen to it at their leisure, as well as to forward along to others who may not have been able to attend today's webinar. So before we get started, I'm just going to go ahead and read off our disclaimer because today's event is basically designed to educate the public and not to more or less steer anyone towards investment. So with that being said, let me just go ahead and get to our next screen here. And then we'll go ahead and let Mr. Silverman go ahead and take things away as it relates to the actual event in terms of trust deed investing. So actually what we're going to go ahead and do, I'm going to go ahead and pass this here over to Bruce, and we'll come back to the disclaimer. And I'm sure Bruce has his disclaimers that he's going to read off, and then I'll go ahead and read off the disclaimer as it relates to what we do as a service provider in the form of trust in terms of IRA investing. So just gives me a second here. I'll go ahead and pass this over to Bruce, and I'll go ahead and let Bruce take it away. Okay, Bruce, can you see?
Yes. I think you can see my screen now. Can you not?
I can see your screen now. Perfect.
Okay. Thank you very much, Lamarr, for that kind introduction. A little bit about myself. I've been in mortgage banking and real estate for 24 years, and I represent HomePath Financial, which is an accredited business with the Better Business Bureau and an A+ rating. My topic today is going to be passive real estate investing using trust deeds. In today's uncertain world, investors are looking for security, return on investment, and perhaps cash flow. Now, I don't want you to think about being a real estate investor. What I'm talking about is an investment vehicle secured by real estate. Now, what I mean by passive real estate investing is a way to make money in real estate without having to look for property, deal with contractors, realtors, tenants, vacancies, vandalism, etc. People who do that are real estate investors, and you need a lot of time, a lot of money, and a very thick skin to do that on your own. Now, there are established companies in the country, such as HomePath Financial, that buy, rehab, and sell foreclosed property. Now, this is commonly known as flipping. In today's upside-down real estate market, this is one of the few ways that people are actually making money in real estate. Perhaps some of you have even seen or heard of the television show Flip This House. What these companies do is buy at a discount, renovate the property, and then put it up for immediate resale. Now, the first question people have is, where does this money go? Rehabbers purchase single-family residential homes, no multifamily, no commercial, and there are clearly defined purchase parameters. The ARV, or after repair value, must be between $100,000 and $500,000. We typically work in the $100,000 to $300,000 range. Now, this not only limits the risk by staying in the middle-class neighborhoods, but it also stays within the confines of traditional financing, which is your FHA, Fannie Mae, Freddie Mac. No jumbo financing is needed. rehabs are only done in desirable suburban neighborhoods, in specific metro areas, in strategic markets only. Standard 3-4 bedroom homes, no unusual limiting factors, and this allows us to do a quick resale. The average renovation costs run around $20,000 to $50,000. This is determined by the rehabber in each metro area and typically consists of a consensus between the rehab project manager and the marketing specialist. Improvements are based, of course, on what areas can bring the home up to and beyond comparable sales and which has the largest impact on value. Typically, these areas are kitchens, bathrooms, and landscaping, and I'll go into some examples in a few minutes. Now, rehab companies typically pay investors returns in the 8 to 12% range for the use of the money. Now, this is all secured by the real estate that's purchased. Now, what I'm talking about is making money just like a bank does, with all the same protections and security that a bank has, except with a much higher return. Now, there's 7 different ways that the money is secured, and let me go into that first. Initially, a loan agreement is signed outlining the amount borrowed and the agreed interest rate. Also, an escrow agreement is executed setting up an independent third-party escrow account in the lender's self-directed IRA's name. So you're not giving the money directly to the rehabber. The money will go into an escrow account in your name. After the loan agreement and the escrow agreement are executed by both parties, the borrower, that's the rehab company, also executes a master deed of trust. The master deed of trust acts as an umbrella over the investment. At this point, the lender would wire their money not to the borrower, but into the independent third-party escrow account. Now, these are the first 3 levels of security. This is commonly known as trust deed investing. Trust deeds evidence a mortgage loan secured by a promissory note. At the closing of the first property, the promissory note is executed for the full amount invested and outlines the interest rate, the term, and the length of the contract. Now, this is the 4th level of protection. Now, this is the most common way to structure real estate purchases where the title to a property is held in trust until the loan for the property is paid. The SDIRA is the lender, the rehab company is the borrower, and a promissory note is executed for the amount borrowed. The lender is also issued a supplemental deed of trust for each individual property that's purchased. And that is the 5th level of security. There is no commingling of investor funds, and each loan is in first position. Now, the basic business model that we operate under is we will purchase the home, rehab it, and have that property sold within 120 days. One of the keys to our success is that we purposely mark the property 10% below market so that we can liquidate it quickly. In other words, if we purchase a property, we'll purchase it, rehab it. Let's say it's got a $200,000 after value. We will not be in for more than $150,000. That includes acquisition costs and all the rehab costs. And then when it comes time to sell it, we'll mark it at $180,000, which is $20,000 below market, and we'll be able to sell it quickly because we'll have the nicest house on the block and we'll be offering it 10% below market. And that's the key to our business model, and that's why we've been successful for the last 8 years, even in the real estate downturn, because we were able to turn the properties quickly. And that is the key to being successful in flipping. Now, our properties are sold outright to pre-approved conventional buyers. This is our exit strategy. Any property that sits beyond the 90 to 120-day cycle is price reduced aggressively to move the property, even if it means taking less profit or even a loss. The priority is to move the properties every 120 days and not hold on to them. Let's talk some more about your protections. If a borrower were ever to default on payments, the private lender is protected by an altered title insurance policy that provides a first lien position on a fully improved property in a desirable neighborhood with equity present. Any monthly payment defaults can be foreclosed upon with collateral legally transferred to the private lender's name within 60 days. The investor then has the option to keep the property as a rental, sell it immediately to a wholesaler, recapturing principal, or you can continue selling the property for a profit as planned. Now, HomePath Financial is fully transparent. Appraisals are provided if requested. You have the ability to meet our rehabbers and the realtors that we work with, and you can also meet or talk with any of the principals or our real estate operations managers. Now, what we also do is pay all the costs associated with the transaction. You as the lender incur no costs. We, the borrower, pay all the costs. That includes closing costs, title insurance, liability insurance. There are no costs or fees or of any kind to the lender. There's no management fees. There's no annual fees. There's no service fees. We will even pay the $300 yearly fee to maintain the escrow account. So that is just another level of protection, and again, there are no costs or fees to you of any kind. Now, as I said earlier, the yields on these simple interest loans generally run in the 8 to 12% range. It depends upon the amount invested and the term of the contract. We typically like to do 18-month contracts, and the contracts are renewable. 90% of our investors do renew. And the reason they renew is because the returns are so good, and of course some of the retirees like the cash flow. Interest payments are made directly into your SDIRA account the first of each month by direct deposit. So you don't even have to go to the bank. The interest payments are paid by ACH every month on the first of the month. Now, using an SDIRA account to fund these projects allows the interest to grow tax-free, and of course it goes much faster than with any of the traditional investment strategies today. And I'm going to give you a couple of examples. If someone were to invest $100,000 for 12 months with a 10% return, they would receive a direct deposit of each month for $833.33, or a total of $10,000 in tax-free income for that year. And if they decided to not renew their contract, they would get the entire $100,000 back at the end of the contract. Now, a second example would be if someone were to invest $300,000 at 12% APR for 18 months. It's a larger investment, longer term than the first example, and the interest rate's higher. Now, they would receive a direct deposit of $3,000 on the first of each month, a total of $54,000 in income for the 18-month period, and a entire principal investment of $300,000 would be returned at the end of the contract if they decided not to renew. Now, we will call the lender 3 months before the contract is due to expire and ask if the lender plans on renewing. If you not to renew, all draws from the escrow account cease, any remaining projects are completed, and the properties are sold. Again, full principal investment is returned at the end of the contract. Now, this is an excellent way to get very attractive returns, diversify a portfolio, and get cash flow. Cash flow can be very important for people who are retired who need to get a better return to supplement Social Security. It's an excellent way to replace underperforming IRAs and 401s, which typically are paying in the 3 to 6% range and have various fees and charges which actually reduce that return. For anyone currently in safe havens like CDs or treasuries, this investment will pay 6 to 8 times what you are currently earning. Now, to summarize, the 7 levels of security are the loan agreement, the escrow agreement, the master deed of trust, funds held by an independent third-party escrow company, a supplemental deed of trust for each specific property purchased, an alter title policy for each property, and the insurance policy with the lender as a loss payee. So those are the 7 levels of security. Now, let me go to the next slide. Okay, this is a truly passive investment strategy. It's secured by real estate, and it is allowed, let me just take that out of there. I apologize. It's an allowed SDIRA investment under current IRS rules and regulations. Okay, the next slide is a first example. This, again, we're fully transparent. This is the address of the property that was purchased. We paid $129,000. The repairs, costs, and commissions were $30,000. The sales price was $181,500 for a net profit of $22,500. The days on the market were 91. If you look at the 4 pictures on the top, those are the before pictures. And then if you look at the 4 pictures on the bottom, that was the property after the rehabilitation was complete. In recent example 2, this is a property in Texas, Dallas, Texas, purchased for $69,500. Commissions, repair costs were $24,000. Sales price $129,000. We had a net profit of $23,000. Days on the market 90. Again, the 4 pictures on the top were before, and the pictures on the bottom show after. I want you to pay careful attention to the kitchens and bathrooms. In these examples, you can see these houses were completely redone. Tile floors, all new fixtures, granite countertops, stainless steel sink. These were completely renovated and modernized homes. And again, we try and make these houses the nicest house on the block so that they will sell quickly. In recent example 3, this is a house in San Antonio. We purchased it for $100,000. Repairs were $24,000. We sold it for $147,000. Net profit was $23,000. Days on the market 118. Again, pay careful attention to the pictures on the bottom. You can see the tile floors, the all new cabinetry, all new appliances, stainless steel sinks. Absolutely magnificent home, completely updated and modernized, and it did sell within the 4-month time frame. My last example I'm going to show you today was another house in Dallas. We paid $150,000. The repairs, costs, and commissions was $40,000, so we were all in at $190,000. We sold it for $215,000, made $25,000. Days on the market 109. If you look at the before and after pictures, you can see that this house did a complete 180. It went from an old, dated, tore-up house that we completely redid, and if you look at that kitchen, it is absolutely magnificent. And hardwood floors, just an absolutely magnificent house, sold in a little over 3 months, and we made $25,000. So that's I just want to give you some examples of what we do and why it works for us. Now, as I said before, this is a great investment for self-directed IRAs, as it is a truly passive investment strategy, fully allowable under IRS regulations. Now, for those of you unfamiliar with or starting a self-directed IRA, I highly recommend a professional company like Accuplan Benefit Services to set up and administer your account. Now, lastly, I want to talk about something that's just slightly outside of the actual monetary aspects of what we're talking about. This is a great investment strategy. It's secure, has a good return, has good cash flow. But there's something else that we bring up that is very, very important. And this is a very pro-American, pro-jobs investment. Several things are accomplished that contribute significantly to our economy. First, we are clearing inventory and increasing the value of all homes in the neighborhood. Secondly, we are putting the construction folks, the painters and landscapers, back to work. We are also buying fixtures, new appliances. Third, we are putting realtors to work by giving them beautiful, newly renovated homes to sell. And lastly, we are putting mortgage brokers back to work, arranging financing for the purchase of the property to qualified borrowers. We have a whole network of realtors and mortgage brokers that we use that market these properties and move these properties and get these properties financed quickly and off the market. So this is something that it's just a little caveat. It's a little something I like to throw out there. This is a great investment strategy, but you're also helping the economy as well. And that's something that is important to a lot of people. You know, everybody complains about the economy, but they say, what can I do about it? This is a way that you can actually put people in this country back to work. I do want to thank you for your time. I put some information up on the last slide as to how you can get a hold of me if you have any questions or you need more information. We are willing to provide anything that we can. We are fully transparent, as I said. My phone number is 770-842-2015. My email address is bruce@myhomepath.com, and our website is myhomepath.com. And I thank you for your attention and your time, and I would ask now if there might be any questions.
Well, Bruce, we're going to go ahead and hold the Q&A session until the last 10 minutes of the actual webinar. So actually I'm start seeing some of the questions coming over. So like some pretty good questions. So we're going to go ahead and just kind of roll along, and then we're going to hold all the questions towards the very end, which we'll go back and forth and answer the questions. So great presentation, great information. As I mentioned in the beginning of the presentation, our objective here at AccupLan is to educate both existing account holders as well as those who are looking to set up a self-directed IRA as it relates to what investment options you have out there that are outside of Wall Street and traditional investments. A lot of clients are looking to get into real estate investing but may not have the ability to directly invest in real estate, and of course trust deed investing is a great way to get into real estate investing and take a passive approach. So I'm going to go ahead and get started on my presentation in terms of how to use the self-directed IRA and what your options are using the self-directed IRA to invest in something like trust deeds or other alternative investments when it comes to real estate and other different types of transactions. For those who joined the webinar late, as I mentioned in the beginning of the presentation, the webinar is actually being recorded. So within the next 24 to 48 hours, you'll be receiving a link of the webinar in its entirety. Feel free to listen to it at your leisure, and as well as pass along for those who are not able to attend the webinar. So I'll go ahead and get started. As I mentioned, I'm the Director of Business Development for AccupLan Benefit Services. My name is Lamarr Baxter. My territory, I cover all of Northern California, but of course I work with both real estate investors, all types of investors nationwide, as well as other investment professionals who refer clients over to make alternative investments. Investing in trust deeds is just one of the many, many investment options available to you using the self-directed plan. And we're going to cover the different types of plans that's available to you. Before we get started, as I mentioned earlier, that we provide education. We do not endorse any products, so any information that we have covered today is more or less for educational purposes only, and really just to educate you and let you know what your options are. You definitely, as with any investment, you want to make sure you consult with your legal professionals to vet and do all the necessary due diligence before you take part in any investment. As mentioned earlier, we do not provide any financial as well as legal advice. So once again, definitely consult with your legal professionals as well as any other professionals to aid you in making a decision to move forward in any investment. Accuplan Benefit Services is a national company. Our specialty as an administrator as well as a custodian is to offer self-directed plans, not just for the IRA, but also for those who are seeking to establish a 401k. Something that's really popular is for those small and medium-sized businesses is to establish a self-directed 401k, also known as a solo K, in which we call our 1K. We pride ourselves in an expertise in low-cost and quick service of self-directed IRAs and 401ks. Pretty much everyone on our staff has 20-plus years of experience in relative areas of investment, finance, and other areas that basically will cover almost every spectrum that you would use this type of account for investing. So once again, we have a great staff with a lot of with a lot of expertise and knowledge over, say, 20-plus years. So I'm just going to go ahead and move along here. Pardon my delay here. For some reason, it seemed like there's a delay in terms of advancing the slides. But what we're going to talk about, as I mentioned here, is actually how do you actually use the retirement account to go ahead and make the investment using the self-directed plan. One of the things I like to share is statistics. Why are people looking at the self-directed plan, and why should they be looking at it in terms of alternative investments outside of traditional investment? When I say look beyond traditional investment, I'm not saying abandon traditional investment. What you really want to do is really look beyond just traditional investments and truly diversify your investment portfolio. So just some statistics before we get started, some things that are motivating people to kind of somewhat come off the fence and to move forward to grow their retirement account. They say as of January 2011, it was estimated that 10,000 baby boomers per day will turn 65 for the next 19 years. Of that segment of the population, up to 75% or more of that population do not have the resources to retire after the age of 65. Most will be forced to continue to work beyond the age of 65, and that's provided if their occupation or the organization will allow them, depending on what they perform on a daily basis, if there are any type of physical limitations that may prohibit them from performing their tasks. So that may not be an option for them to work beyond the age of 65, which is another reason you want to take a proactive and aggressive approach in terms of looking at all investments options available to you to grow your retirement account. Retirees will face skyrocketing health care costs and diminished Social Security benefits, and we're beginning to see that in the fiscal cliff negotiations, if that's what you want to call it, in terms of attacking Social Security and taking away certain benefits. So a lot of benefits that previous generations had counted on once they retired may not be there for us. So it's important that we, once again, take that proactive approach to grow our retirement account. We're going to talk about also the inflation and cost of living. So there's another set of expenses that you're going to have to deal with moving forward. That's going to pretty much outpace the amount of money that you have in your retirement account or any other fixed income that you may have. You have to factor in inflation and cost of living. So it's estimated at $4.7 trillion in combined IRA and 401k funds are out there, and basically people have that type of money invested into a combination of IRA and 401ks. And of that $4.7 trillion, only 1% are invested in traditional investments or self-directed accounts. So we definitely really need to increase that number from 1% up to at least something double-digit to kind of give us a chance to basically put ourselves in a position to take care of ourselves and our family. It is estimated that 90% of the population is unaware of a self-directed IRA. And of that 90%, that includes your attorneys, your accountants, and other professionals. It's not anything against those professionals, but once again, this is not something that has been widely used, something that has been marketed by your mass media and some of your commercial institutions. Although this investment vehicle has been around since 1974 as part of the ERISA Act, once again, only 90% of the population is not aware that this investment vehicle is available. Your financial planner wasn't trained on this aspect, and that has a lot to do with the plan agreement that they offer. Their plan agreement basically offers traditional investments. So they may have, say, 15, 20 investment options. And because, once again, it's kind of like an attorney or any other professional. Using attorney as an example, I mean, you have attorneys who have different areas of practice. Not to say that they are not competent in their area of practice, just they have a specialty. And when it comes to a self-directed IRA, what happens is the plan agreement basically allows the account holder to be able to make both traditional and non-traditional investments, something that's not allowed by your traditional custodian. Your current custodian may not offer a truly self-directed IRA. Self-directed is kind of a generic term. You're going to hear it a lot with maybe some of your existing traditional custodians, but their definition of a self-directed IRA is that you may have options. A truly self-directed IRA allows you to invest in everything with the exception of life insurance and collectibles. Those are your only two restrictions in terms of investment classes that you're prohibited from performing in accordance to IRS Code 4975. They said, once again, we talk about diversification. As I mentioned earlier, $4.7 trillion in assets, most invested in Wall Street. The majority of those funds are invested in mutual funds, CDs, and so on and so forth. And as I mentioned earlier, less than 1% is invested in alternative investments. So once again, you have to really kind of take the blinders off and really just look outside of the box that you've been forced in over, say, the last 15, 20 plus years and know that there's other investment options out there for you. The motto of the self-directed IRA industry is invest in what you know and understand. And what does that mean? That means that you shouldn't always be depending on someone giving you third-party information to make an investment decision that's going to affect you and your nest egg, because a lot of times that information may not be accurate, especially long-term. I mean, it's nothing against, once again, the planners and advisors, but it's a situation to whereas information that's usually filtered down to them is usually, I would say, somewhat what we call filtered information, so a lot of time it's not something that you can count on. So what you definitely want to do is kind of go out and do your own due diligence, get familiar with certain area of investment, something that you can go and get some additional training and education on. And in addition to the additional education and training, you definitely want to hire a professional if necessary if you feel that you don't have the tools or the knowledge to move forward. But once again, you definitely want to do your due diligence. These are some of the more common transactions that come across my desk, these four classes here: real estate, precious metals, private notes and loans, and private companies. Back to real estate once again. Bruce talked about passive investment using trust deeds. So one of the options, or many options you have with the real estate aspect, is you are able to invest in single-family residence. As Bruce indicated, you can actually invest passively through trust deeds. You can actually become a private lender directly or indirectly. Invest in single-family residence, multi-family residence, raw land. So pretty much the sky's the limit. There's no restrictions on any type of real estate that you can hold within a self-directed plan. There's also no time frame in terms of how long you can or cannot hold the asset in your self-directed plan. Precious metals was real popular up until, say, 2010. It kind of hit a plateau, but we're looking to see that take off again depending on what happens with this fiscal cliff negotiations that's going on, because as we know what happened in 2010, as the value of the dollar started to decline, the prices of precious metals started to actually increase. So that's something that is being forecasted as a possibility of happening again. But once again, it's not to steer you towards any particular investments, just to let you know that there's a lot of opportunities out there in alternative investments, and these are some of the ones that a lot of our clients are taking advantage of. Private notes and loans, that would also fall in the category of real estate. Private notes and loans does not always have to be associated with real estate. There's certain provisions right now that are in place with custodians. In the past, you were able to set up a situation to where you can actually loan money secured or unsecured out of your IRA, but the IRS is actually tightening up on unsecured loans because what they're beginning to see a very high default rate on unsecured loans. Maybe it's going to be a contributing factor based on maybe these loans weren't actually performed or set up in a proper manner. But in any case, in most cases, what will happen is if you are giving money, lending money out unsecured, there's a high probability for default because, once again, there's no incentive for that borrower to pay back the funds. So once again, many custodians are basically steering away because the SEC is beginning to look at these types of transactions a lot closer, because these types of transactions, meaning unsecured loans, are involved in a lot of fraud. So if you're looking to go that route, you may be forced, depending on the custodian, to go to a different custodian for that setup of a transaction, or you may be forced to use an IRA-owned LLC to conduct the transaction because of the potential liability to the custodian. Private companies, there's a lot of organizations, new or existing, that are starving for cash right now. There's clients of mine that are actually investing in startup businesses as well as investing in existing business that are basically in use or in need for cash. For example, you can have an organization that's been around for the last 15, 20 years. They may not have access to credit lines because, we mentioned before, the banks are no longer lending, at least not at the levels they had in the last 5 or 6 years. So if there's a situation to where you can actually use your self-directed plan to actually invest in a company by private stock, investing in terms of securing collateral within that company, whether it be through a UCC1 or some personal property owned by the organization. You have a lot of options available to you once again to also be able to invest in some private companies. So we're going to go ahead and move to the next slide here. Let's see. As I mentioned earlier, I showed you the 4 more common transactions that comes across my desk, but this here's to kind of give you an idea of a lot of the transactions that I've seen that's pretty much happening nationwide, what a lot of people are using just across the U.S. when it comes to a self-directed IRA. I'm sure if you were to contact your custodian, if you do not have a self-directed plan and you have your traditional IRA or 401k and was asked, do you have the option to make any type of investment based on the list in front of you, I'm sure the answer would be no, because once again, their plan agreement does not allow you to invest in anything that is not what they consider traditional investments. So we're going to talk about prohibited transactions because there's rules that you must follow. I mean, I told you all the great things about the self-directed plan, but there are rules that must be followed to ensure that your plan is not disqualified as a result of you violating IRS Code 4975, whether it be a prohibited transaction or working with disqualified parties. So we're going to cover both prohibited transactions and disqualified parties. What that means is you have restrictions on who you can and cannot do business with, what types of transactions you can and cannot do. As I mentioned earlier, your restrictions are life insurance and collectibles. Your IRA cannot engage in any transaction directly or indirectly with anyone who's considered a disqualified party. Some examples of prohibited transactions would be a disqualified person. We'll talk about who disqualified persons are on the next slide. Would basically involve any disqualified person who's selling and exchanging or leasing property or having any type of transaction that would involve any disqualified party. So what basically they're saying is no self-dealing and no personal use. So if you're looking to purchase real estate, you cannot actually live in the property, nor can any other disqualified party live in that property. There cannot be any immediate benefit to the IRA holder or any of the IRA holder's relatives, or at least certain relatives who fall in the category of being a disqualified party. And I know Bruce mentioned earlier that's one of the things you don't have to worry about. If you get a little leery about, well, I want to make sure I don't disqualify my account, so it just seems like it may be too tedious for me to actually acquire real estate. One of the things that's nice about the trust deed investing is because it's a pretty straightforward transaction. You're pretty much the equivalent of a bank. You basically will be paid off when the property is refinanced or sold, and you have a secured interest against the property. So it's not only a passive approach, but a less risky approach in terms of you not committing any prohibited transaction, because once the transaction is funded, you're secured via deed of trust on their property, and once again, once their property is sold or refinanced, you're paid out your principal investment plus your return. Okay, the next slide, as I mentioned, we talked about prohibited transactions. This slide, we're going to talk about disqualified parties, who you can and cannot do business with your self-directed plan. Some examples of disqualified persons would definitely be yourself, your spouse, parent, grandparent, children or grandchildren. And so basically what I usually like to give is what's a visual. Anyone who's on the vertical line of the relationship chain is basically considered prohibited. Whoever's on the horizontal line, which would be, say, for example, brothers and sisters, aunts, uncles, those would be permissible parties for you to conduct business with using your self-directed plan. So when we say lineal and descendants and descendants, that would include, once again, your spouse, their son or daughter, children or grandchildren, parents or grandparents would be disqualified parties. So it's important that you follow these rules to make sure that your account is not disqualified. And disqualified would basically result in full taxation at ordinary income, and if you're under the age of 59 and a half, would also include an early 10% distribution penalty. In addition to the disqualified parties, entities that will fall into that category would be any fiduciary to the IRA, and whether that's direct or indirect. Anyone providing services to the IRA. So if someone wanted to, if I wanted to conduct business with one of my clients because I'm actually providing a service to the IRA in the form of a custodian, I would be considered a disqualified party, or should I say accuplan would be considered a disqualified party as well. Corporations and partnerships and trusts, certain entities, whereas you as the account holder or your spouse, who's also a disqualified party, who owns 50% or more of that existing entity, is considered a disqualified party and will result in a prohibited transaction as a result of any transactions. So Give you an example. You own an existing LLC and you want to loan money to that LLC. The rule is that neither your spouse and yourself combined can own more than 50% ownership interest or controlling interest within that entity. Now, if you fall below the 49%, say 49% just to be safe or less, then you can actually loan or conduct business with that entity. So you definitely want to make sure that that remains the case. And a lot of times a question comes up, what happens if it starts off as, say, 48% and over time my ownership interest, including my spouse, exceeds the 50%? It will still be treated as a prohibited transaction. So at that point, you would more likely have to dissolve that relationship if it gets to that point to prevent your account from being disqualified. So basically what I'm saying in summary is that, you know, there's a lot of opportunity with the self-directed plan. As long as you follow the rules, you shouldn't have any problems. So really you just do not want to take any shortcuts, because the IRS is definitely looking. And as we all know, the federal government as well as our state and local governments are starving for cash right now, and they're turning over every rock, and they are paying a lot of attention to the self-directed plans because of some of the abuses and fraud. So you definitely want to make sure that you're following the rules, and if you have any questions, you definitely want to be speaking with your tax professional as well as your custodian to make sure that your transactions are compliant. So the next question is, okay, I want to go ahead and get my account started. How do I fund my account? What are my options in terms of moving funds from an existing account, whether it be an IRA, 401k, or an other employer-sponsored plan? Well, here are your options. The first transfer or method is going to be a transfer, which usually involves moving monies from one IRA to the new IRA, which will be a self-directed IRA. And that process usually takes anywhere from 7 to 10 business days after you've already established your account. So usually you want to definitely establish your account. Once your account's established, you're going to be issuing an account number and a legal vesting. At that point, you'll complete our internal transfer form. We'll go ahead and forward that original over to your existing custodian, and within once again 7 to 10 business days, a check will be sent over to us or the funds will be wired. Rollover is usually going to be associated with moving funds from a 401k or any other type of employer-sponsored plan. The process is a little different. We don't complete any forms on our end because all forms are usually completed internally within that custodian. They don't honor third-party forms, although you will be completing what's called a rollover certification form, which is a document that we have on file. So when those funds arrive, as part of our reporting to the IRS that those funds were received in the form of a rollover and also received within a 60-day period. And speaking of rollover, you do have within 60 days, whether the funds are sent directly to us or to you as the account holder, to make sure that those funds are deposited into a new retirement account within 60 days from the date on that check, to prevent it being considered a distribution and you being taxed, and if you're under the age of 59 and a half, assess a 10% early distribution penalty. Contributions are going to be relative to the different types of plans that's available to you or that you would qualify for be opening up an account. So we'll talk about the different plans and their contribution limits on the next slide, but that is another way you're going to, another option you have in terms of funding your self-directed IRA or 401k. Conversion is usually where you're going to be transferring funds from a tax-deferred account over to a Roth. And of course now with taxes looming and will continue to loom in terms of possible tax increases, a lot of clients are looking to pay taxes now at the lower tax rate. It's not required, but it's definitely an investment strategy depending on what your tax professional may or may not advise you to do in terms of making sure you're in the best possible situation tax-wise. So this is something you want to definitely consult with your tax professional in terms of whether you should or shouldn't convert, whether you should convert partially or fully. I mean, you do have the option to perform a full conversion or partial conversions, depending on what you can withstand in terms of tax liability for that tax year. Okay, the next slide, we talked about on the previous slide in terms of contributions. These are the type of accounts that we offer that can be self-directed. So these are some of the accounts I'm sure you've probably seen with your existing custodian. When we say existing, your existing traditional custodian. All the rules are the same when it comes to contribution limits and so on and so forth. We all follow the same rules in terms of IRS and when it comes to contribution limits and things of that nature. So nothing would change. So for example, if you have a traditional IRA, it's say Charles Schwab, and you're trying to determine whether the contribution would be the same on your Charles Schwab traditional IRA versus your accuplan traditional IRA, the rules would be the same, the contribution limits would be the same. So just a real quick list here. This is the contribution limits for the year 2012. On the next slide, we'll be talking about what the contribution limits are for 2013. So just kind of give you a quick summary of the different types of accounts for those who you're not familiar with the different types of accounts that are out there that can be self-directed. You have your traditional IRA, which is a tax-deferred account. Your contribution limits for 2012 is up to $5,000, and you have a $1,000 catch-up if you're over the age of 50 and a half. You also have the Roth IRA, which is a tax-free account, same contribution limit, same catch-up limits. The difference with this account is that you pay taxes. Once you've paid taxes on this account here, and you've met the two milestones that you're to the age of 59 and a half, and you've had the account for 5 years, you pay no federal income tax on the growth. So that's pretty attractive. If you're in an investment vehicle to where you're making some double-digit returns, you want to make sure that you pay as little taxes as possible. So you may want to consider once again is maybe converting and paying the taxes now either partially or fully to make sure that you do not get taxed at a higher rate in the future, because it's almost certain, depending on who you talk to in terms of financial expert and tax experts, that taxes will be increasing because of our soon-to-be $18 trillion deficit. The SEP IRA is a tax-deferred account as well. This is something that's more popular with the self-employed than those who are 1099. The real estate professionals really take a great advantage of the SEP IRA, as well as attorneys. Anyone who's 1099 or self-employed, this is a great investment vehicle because you have a higher contribution limit than a traditional or a Roth IRA. However, you have the ability, once again, it's a more simplified plan than, say, a 401k. Your contribution limit on this here is up to $50,000, and there is no catch-up on this SEP IRA. Prior to, say, 2000, I think it was 2010, it actually got rid of the catch-up on the SEP IRA. The simple IRA is for those small or medium-sized businesses with less than 100 employees. This is more of a simplistic plan also. It's kind of a smaller version or simpler version of a 401k. But it's kind of on the same lines as a SEP IRA, a lower contribution limit. And like I said, it's a simpler plan for the small and medium-sized business with less than 100 employees to be able to administer and offer to their employees. The 1K, also known as a solo K, is I would say a hybrid between a SEP IRA and a 401k. This here is considered an employer-sponsored plan. Your contribution limit on this here basically allows you to contribute as both the employer as well as the employee up to $50,000. You do have a catch-up on this for if you're over the age of 50 and a half, you can do an additional $2,500 catch-up each calendar year for this type of plan. One of another benefits for this type of plan, if you're looking to use any form of leverage, there's a term called unrelated debt finance income tax, and what that is, that's relative to if you're looking to acquire an asset and use any form of leverage, there is a tax assessed to the portion of profits derived from the leverage used to acquire the asset. The 1K or solo K is the only plan, because it is an employer-sponsored plan, that is exempt from UDFI, also known as unrelated debt finance income tax. But there's something to consider if you're looking to go between either the 1K or the SEP IRA. Both are should I say, for those who are self-employed or 1099, but that would be the difference if you were looking to ask the question, why would I consider the SEP IRA versus the 1K? You have a lot more flexibility. And then one of the other benefits also, because it's an employer-sponsored plan, the 401k portion of the solo K, you can actually borrow against that amount up to $50,000 as with any 401k. So the next slide here, we're going to look at what the contribution limits are looking for 2013. So you definitely, once again, you want to take a look at these limits, check with your tax professional to see. When I say contribution limits, these are limits up to these amounts. So there's some situations as to where maybe if you are over a certain dollar amount in terms of your modified adjusted gross income, you may not be able to contribute this full amount. So you definitely want to consult with your tax professional to ensure that you're not going to be in a situation where you're making an excess contribution, which of course in an excess contribution scenario, there's 6% penalty for any excess contribution beyond that amount until that excess contribution is taken care of. So how do you actually go about setting up your account and actually, for example, making an investment in a trustee transaction? So the first step is to open your account. It's very important that you establish an account because you're going to require an account number investing to go on any contract or documentation relative to the transaction that you're going to be making. You definitely want to fund your account, whether it be from a transfer, rollover, conversion, whatever method you're going to use to fund the account, you definitely want to get that taken care of. Once your account's established and funded, you're going to complete one of our internal forms, called an investment direction form. Basically, it's a one-page document. In addition to the additional documentation you'll be submitting along with this document, you will basically instruct us as the trustee to act on the behalf of your retirement account to direct funds toward a particular investment. Once the funds, like I said, once this form has been completed and all the documents have been received, such as in this case it would be a complete promissory note and a deed of trust and any other documentation that would accompany that type of transaction, you get that over to us. And usually within 2 business days, provided there's no errors, we can usually get that transaction funded via wire or via a check. So it's a pretty simple transaction, simple process, just a matter of making sure all the documents are completed correctly and timely to get your transaction funded. So here's a flow chart of times, once again, to give you an idea of what the process would entail in terms of establishing your account, funding the account, and also funding your investment. So take a close look at this to kind of give you an idea of what the process may be. I'm sure if you contact your planner's advisor, they'll probably tell you, oh, it's convoluted, but this is your visual here to kind of give you an idea of what the process would consist of in terms of establishing an account to make any type of alternative investment. So in summary, IRAs can hold all types of investments, not just securities. So once again, think outside of the box. There's nothing wrong with traditional investments, but there could be a problem in terms of holding just traditional investments. You also want to consider alternative investments to truly diversify your investment portfolio. Partnerships and split ownerships are allowed. We didn't really talk about that, but that is an option that's available to you if you're looking to commingle, or should I say partner, private funds and IRA funds. There's some rules that will allow you to, depending on the structure of the transaction, that will keep your transaction compliant and allow you to partner with private funds as well as other retirement funds as well. Just kind of give you an example, there's those who do not maybe want to take on the task of converting monies from a tax-deferred account to a Roth account. So what they're beginning to do is to partner, for example, a tax-deferred account such as a traditional IRA and a Roth IRA, and over time they may convert a portion, if not all the funds, over to that Roth account, but it gives them flexibility to be able to grow both accounts, both tax-free and tax-deferred. The IRAs in individual case can grow tax-free or tax-deferred, so depending on what your objective is, you have the ability to grow your retirement account plan tax-free or tax-deferred. One of the things I forgot to mention in the individual K plan, you do have the option to contribute to that individual K plan or the 1K or solo K in the 401K bucket. You can contribute tax-deferred or tax-free. We do have what's called a Roth option to where you can contribute up to, say in 2013, the contribution limit is $17,500, where you can actually make a contribution up to that amount into the Roth bucket of that plan. So if you have any questions on that, feel free to give me a call. I know a lot of people are kind of deterred from actually opening up a Roth account because the $5,000 doesn't seem like enough to be able to grow that plan. However, if you're self-employed or 1099, you definitely want to look at the solo K because it does have the Roth option to where you're allowed to contribute a lot more than $5,000 towards that plan. So I can't reiterate more. Lastly, we got all plans qualify for partial transfers and conversions. Partial transfers, a lot of times a lot of people feel that they have the obligation to transfer all their funds. I mean, once again, we emphasize true diversification. Don't put all your eggs in one basket. You may like how some of your stocks are performing on Wall Street. So leave those funds where they are, so you do have the ability to liquidate a portion of your existing IRA and transfer those funds over to accuplan or any other custodian to make an alternative investment. So you do have flexibility. You do not have the flexibility in terms of doing a partial rollover, in terms of moving a portion of a 401K. A lot of times once you move from your existing employer, either because of retirement or termination, you have to move that entire plan over to a IRA or another 401K. You do not have the ability to do a partial rollover. Be sure to establish and fund your account prior to entering into contract. It's not necessary, but depending on the transaction, if it's a time-sensitive transaction or if it's a multiple offer situation, especially nowadays, it's pretty competitive trying to go after shrinking inventory. So you definitely want to be in a position, one, to make sure that your account is established and funded. Definitely established, because you are not able to enter in a contract under your name and then transfer over to your IRA. That would be considered a prohibited transaction. Some will assume that they can go into contract under their name, complete an addendum, and transfer it to the IRA. The IRS looks at that as the contract as a instrument that has value and will deem it as a prohibited transaction. So regardless of anyone tells you that you can transfer it via an addendum, do not go that route, because if we see anywhere in the chain of the paperwork to come across our desk that your name personally was on that contract, we're going to kick it back and you can't correct it. And if it's a short sale situation, if you're too far in the process, it's almost guaranteed that they will cancel the contract and entertain the backup offer. So make sure you establish and fund the account if necessary before you go into contract. So that is my presentation, and we're going to go ahead and open this last 10 minutes up for Q&A. Let's see, Bruce, do you see any questions coming? Or I see a few here. If you want to get started, I can get started, whichever you prefer.
Why don't you get started?
Okay, let's see. I'm looking here at the first question. This one will be more or less directed to you, and I'll go ahead and read off the question. I'll go ahead and let you answer. Then any questions relative to what I covered, I'll go and answer the question. What is the minimum amount one can invest in a trust deed? I guess this would be someone who's looking maybe to have a self-directed plan. They may not have enough to go out and purchase a piece of property outright, but want to know what the minimum usually on something like this would be.
Well, there's several ways to look at it. If you look at HomePath Financial, we allow people to come in with as little as $25,000. But at that level, a first lien position cannot be guaranteed and won't be given. We work with houses in the $100,000 to $300,000 range. So to be guaranteed a first lien position, the minimum investment would be $100,000. We will accept investments in the $50,000 to $100,000 range, and those investors would be in second, and then in the $25,000 to $50,000 range, they would be in third position. The interest rates remain the same. We're not going to pay less interest, but because they're putting in a lower amount, they might not be in a first position. So someone can invest in trust deeds with as little as $25,000. Your lien position is going to be dependent upon the amount invested, and to secure a first position lien, it would be $100,000 minimum.
Got it. And next question, I guess, would be directed towards me. Does accuplan offer or allow checkbook control via an IRA-owned LLC? And the answer to that is definitely yes. I know some custodians are kind of steering away from it, and it's not that because it's a prohibited transaction. It's just based on how their staff and any type of problems they may have had as relates to compliance and abuse with the LLC. It's usually a lot of times you may find conflicting information on whether this is an allowable structure, but it's definitely an allowable structure until IRS says otherwise. Basically what you want to do is say using an IRA checkbook control account, you're going to establish the self-directed IRA, and then what you're going to do is once the account's established and funded, you're going to form the IRA-owned LLC. Once that IRA-owned LLC is established, you're going to direct the custodian to transfer those funds over to the LLC, in which at that point the LLC conducts transactions, buy and sell assets. So for example, if you're looking to purchase or invest in trust deeds, those trust deeds or the lender of any trust deed investments you would make would not be your IRA, but will be the name of whatever you would name your LLC. So it provides you both checkbook control, and for those who are looking for asset protection, it does have a feature of asset protection using the checkbook control feature. Looks like we had another question here. Where are the properties located that you're investing in?
Okay, we with HomePath Financial have worked in several states. The company was founded and originally incorporated in Wisconsin, and that's where we started. And we did a number of properties in Wisconsin. We've done some in California. We are now centering all of our operations in Texas. We're based out of Grapevine, Texas, which is a suburb of Dallas. And we are doing all of our rehab projects in Texas. And I appreciate the question because this is, there's a very good reason why we're in Texas. And that reason is because that's where the jobs are. 50% of all the jobs created in this country in the last 2 to 3 years have been created in Texas. There's a huge oil and gas economy. There are a lot of tech jobs in Austin, a lot of government jobs in Texas. There's just a lot of employed people there, and because the unemployment rate is so low, we just have a very large pool of qualified borrowers that allows us to move the properties quickly. So we are in Texas, and we are going to be in Texas for the foreseeable future.
Got it. Okay, next question. Can you partner an IRA and personal funds on an investment? I know in the presentation I mentioned that commingling or partnering or actually working with disqualified parties, which would include yourself as well as a spouse. There is what's called a New Deal exception. New Deal meaning that as long as the asset or the investment does not involve either previous or existing ownership interest of either yourself or any of the disqualified parties such as your spouse. Basically, New Deal meaning that as long as there's no previous or existing ownership interest, you can partner with your IRA or partner IRA. So, for example, I see situations where one may have, say, $75,000 in their IRA, but the transaction amount is, say, $150,000. They are in a position to actually use those IRA funds and partner with themselves. However, the rule is that the acquisition amount, or the amount that's going to be contributed towards the acquisition of the property or the asset, is also going to determine the percentage of ownership. So, for example, just use real estate as an example. Use those same numbers. Say it's a 60-40 split. 60% of the monies that were used to acquire the property came from the IRA, and the 40% came from from the actual account holder. The percentage of ownership on that asset would be 60-40. All income and expenses will be also split in accordance to those lines of ownership. So that means that once the property sells, 60% goes to the IRA, 40% goes to the individual, and which at that time, if the account's tax deferred for, say, the IRA, the money goes back to the account tax deferred. If for the individual, they are going to be assessed capital gains tax, or they can do a 1031 exchange. But that's definitely an option.
Well, Lamarr, I also had a question came in that piggybacks on what you just said, because we've had this happen with us. Someone asked, can my IRA partner with my wife's IRA? And the answer to that is yes. We've had people do that. I recently had a husband and wife that came in. He came in with $100,000 in his, and she came in with $80,000 out of her IRA. And they are partnering together on deals, and so the two IRAs can partner together.
Got it. Well, yeah, that's definitely, and that's something, once again, you have the ability to be creative. Maybe that's not something that's available in terms of your traditional investment through some of your traditional custodians, but you can be creative just as long as you follow the rules. But definitely, Bruce is correct. That is an option for you in terms of trust deed investing. Another question here for you, and I think you may have covered it, but once again, some people have logged on late. Is the investor's name on the IRAs? Is the investment of the asset and held in the name of the IRA or the name of HomePath? So I think their question is, who holds title of the property on these transactions, HomePath or the IRA?
Well, the way that most people structure these deals, they set up an LLC that is the lending entity, and their IRA owns the LLC. HomePath Financial acts as the borrower, and the LLC acts as the lender. And what happens is the lender or the IRA is just like a bank. The HomePath Financial will hold title to the property. They buy the property in their name using the investor's funds. The investor is secured with the title policy and the promissory note and a first lien deed, an insurance policy with the LLC listed as the loss payee. So HomePath owns the property. The lender holds all the security instruments. HomePath would renovate the property, sell the property, the funds would flow back to the lender's escrow account. In the event of a default, okay, and this is the worst case scenario, and I want to mention in 8 years it's never happened with HomePath. We've never defaulted on a loan. We've never missed. We've never even been late with an interest payment. But in the rare case of a default, then the lender would have to go through the foreclosure process and would then take possession, legal title to the property and full possession of the property. And in Texas, that can be done within 60 days. On average, I believe it takes 41 days to foreclose on a property in Texas. So that is actually an advantage. Some states, as you may know, the foreclosure process takes a much, much longer time. In Texas, if someone defaults on a mortgage, you take possession of that house within 60 days.
Now, some of your competition, I know, because I know there's a lot of reluctance in terms of, for example, HomePath holding title opposed to the actual borrower, is that what happens if HomePath was, for whatever reason, to run into some financial difficulty, go out of business? Of course, that puts the borrower, or it's just say the lender, at risk, because once again, HomePath had title against the property, where, for example, some of your competition, they're basically using the funds, they're more or less acting as a conduit to where they're using the IRA funds, but actually securing a deed of trust against the property under the name of the IRA or the LLC owned by the IRA.
I understand, but that's more like private lending, you know, and people certainly can get involved in private lending. My opinion is that there's a higher risk of the borrower defaulting and walking away because they don't own the property at all. I mean, it's, you know, we've been doing this for 8 years, and where we make our money is on flipping these houses, and we make our money on the profit, and it's in our best interest to do a good job and sell the properties quickly, and that's where we make our money. My answer is the same. It's the same as the previous question. In the rare case of a default, the borrower just has to go through the foreclosure process. You know, the reason we do it the way that we do it is because it works for us, and the whole key to it is the speed and the flexibility. By us being the borrower and taking title to the property, we are able to do whatever we need to do to move quickly to get that property renovated, get all our crews in there. We'll have 2 or 3 crews working simultaneously, you know, to get that property rehabbed as quickly as possible and on the market. And then as soon as that property sells, the lender does have a first lien position. As soon as that property sells, the money flows from the title company directly back to the lender's escrow account. So HomePath, even though we're taking title to the property, we don't really touch very much of the money. The money flows from the escrow company to the title company to the seller, and then flows back the other way. I don't want people to get the wrong idea. They are not writing a check to HomePath Financial. All they're doing once they executed an agreement with us is they're placing their funds into an escrow account for us to have access to purchase and renovate properties. But all the funds are controlled by the escrow company and the title companies, and we only use the largest independent title companies and escrow companies in the country. As a matter of fact, the company we use is the largest in Texas, and they're a wholly owned subsidiary of First American Title, which is the largest and oldest title company in the United States, with roots going back 129 years.
Got it. We got room for one more question, and this also looks like it's for you. Is what is on a range, just based on a range, what is the average return to the IRA holder or the investor that usually paid out on something like this here, and what is the term?
10 to 12%. Typically, the way we work is we'll pay a 10% return on a 12-month contract, and we will pay 12% on an 18-month contract. And again, we're paying a little higher interest rate because we're having longer use of the funds. And all investors will be contacted 3 months before the end of the contract to see if they're going to renew or not. If they tell us that, yes, we're going to renew, then we just continue business as usual. If they elect not to renew, maybe something comes up, maybe their grandkids need college money and they don't want to renew their contract, they're going to use the funds to pay for a college education, we say fine. We cease all draws from the escrow account. We finish up any projects that are in rehabilitation, sell any properties that are in our inventory with the lender's funds. But regardless of whether all the properties are liquidated or not, I mean, we have a good liquid position. The lender will get all of their funds returned to them at the end of the contract regardless.
Okay.
But we give ourselves a 90-day window, to go ahead and liquidate the properties and finish up any projects, what have you, so that lender does get all their money back at the end of the contract.
Okay. Well, it looks like we run out of time here. Excellent information covered today. I hope everyone got something out of this, and I'm sure there's probably more questions, but once again, we usually try to keep this to a 1 hour maximum in terms of the time. So my contact information is here, and like I say, if you guys, anyone who actually logged on to the presentation late, you will be receiving a link within the next 24 to 48 hours to be able to play back the webinar in its entirety, as well as pass it along to anyone. And actually, before we sign off, I'm going to go ahead and let Bruce go ahead and yell out his contact information again. If you guys have any questions, feel free to give him a call or email him relative to any questions you may have to Trustee Investing.
Okay, I appreciate that, Lamarr. My direct phone number is 770-842-2015, and I can be contacted through email at bruce@myhomepath.com.
Okay, I'd like to thank everyone for attending this evening's webinar. Like I said, if you have any questions, feel free to give us both a call or send us an email. We'd be happy to respond back in a timely manner. I'd like to thank everyone once again and have a great evening. Thank you.
Thank you, Lamarr. Thank you, everyone.